6 signs you should diversify your investment portfolio. Your investment portfolio is the engine of your financial future, a carefully crafted vehicle designed to carry you toward wealth, security, and your long-term goals. In the dynamic world of finance and banking, where markets shift and opportunities arise, diversification is the key to building a resilient portfolio that thrives through economic ups and downs. Without it, your wealth is vulnerable to sharp losses, missed growth, and unnecessary stress. Those who diversify their investments navigate market storms with confidence, while others risk capsizing when a single asset or sector falters. The difference lies in the strategies and habits that spread risk and capture opportunity across a broad range of assets. In this article, we're exploring 6 signs that you should diversify your investment portfolio, inspired by insights from financial experts, books like The Intelligent Investor by Benjamin Graham, A Random Walk Down Wall Street by Burton G. Malkiel, and studies in Journal of Financial Economics. These signs aren't meant to alarm you. They're evidence-based indicators to help you spot where your portfolio is overly concentrated, understand the risks, and take action to strengthen your financial foundation. By the end, you'll recognize where your investments are exposed, how to diversify effectively, and what steps can align your portfolio with a prosperous future. Stay with us until the end, because you might be closer to a balanced, thriving portfolio than you think, and small changes could transform your financial outlook. Let's dive into the signs that you should diversify your investment portfolio and how to build a more resilient strategy. Sign Ascendant. Sign 1. Most of your wealth is in one stock. The first sign that you should diversify your investment portfolio is having most of your wealth tied up in a single stock, concentrating your financial future on the performance of one company. This lack of diversification exposes you to significant risk if the stock plummets due to company-specific issues, such as poor earnings, management missteps, or industry disruptions. A 2019 study in Journal of Financial Economics found that portfolios heavily weighted in one stock are 35% more volatile than diversified ones, as they lack the buffer of varied assets. In The Intelligent Investor, Benjamin Graham warns that overconcentration in a single stock is akin to putting all your eggs in one basket, risking catastrophic loss. Consider 2 investors, Mia and Noah, both 35 years old with $100,000 portfolios. Mia has 80% of her wealth in a single tech stock. When the company misses earnings, her portfolio drops 40%, losing $32,000. Noah spreads his $100,000 across 20 stocks in different sectors, so the same tech dip only cuts his portfolio by 5%, or $5,000. Mia's concentrated portfolio amplifies her losses, while Noah's diversification cushions the blow. Your heavy reliance on one stock signals an urgent need to diversify. Overconcentration in a single stock doesn't just heighten risk, it limits recovery options and ties your wealth to one company's fate. Spreading investments across multiple stocks reduces volatility and enhances stability. The good news is that you can diversify now. Sell a portion of your dominant stock and reinvest in a broad market index fund, like an S&P 500 ETF, to gain exposure to hundreds of companies. Try this. Calculate the percentage of your portfolio in your largest stock. If over 20%, sell 10% and invest in a diversified ETF this month. Reflect on your holdings. Is your wealth tied to one stock, or spread across many? Heavy reliance on a single stock is a powerful sign you should diversify, but you can balance your portfolio for safety. Sign 2. You're overly reliant on a single sector. The second sign that you should diversify your investment portfolio is being overly reliant on a single sector, such as technology, healthcare, or energy, where a sector-specific downturn, like regulatory changes or economic shifts, can tank your entire portfolio. Sector concentration limits your exposure to growth in other industries. A 2020 Journal of Portfolio Management study found that portfolios dominated by one sector are 25% more likely to experience sharp losses during sector slumps. In A Random Walk Down Wall Street, Burton G. Malkiel stresses that diversifying across sectors ensures your portfolio captures varied economic drivers, reducing risk. Imagine 2 entrepreneurs, Emma and Jake, both 38 years old with $150,000 portfolios. Emma invests 70% in tech stocks. When a tech bubble bursts, her portfolio loses 30%, or $45,000. Jake allocates his portfolio across tech, healthcare, consumer goods, and finance, so the tech dip cuts his value by only 8%, or $12,000. Emma's sector-heavy portfolio heightens her losses, while Jake's diversification softens the impact. Your over-reliance on one sector signals a need to diversify. Sector concentration doesn't just increase volatility, it misses growth in other industries, like utilities or real estate, that may perform well when your sector lags. Diversifying across at least 5 sectors stabilizes returns and captures broader opportunities. The good news is that you can broaden your exposure. Invest in sector-specific ETFs, like those for financials or industrials, to balance your portfolio. Try this. List your portfolio's sector allocations. If one sector exceeds 30%, allocate 5% to an underrepresented sector ETF this week. Reflect on your investments. Are you spread across sectors, or leaning on one? Over-reliance on a single sector is a clear marker you should diversify, but you can expand your reach. If you're finding this article valuable, please comment number 2 below to let me know you're here. Your engagement fuels more content to empower your financial journey. Let's keep going. Sign 3. You haven't rebalanced in over a year. The third sign that you should diversify your investment portfolio is not having rebalanced in over a year, allowing your asset allocations, stocks, bonds, or sectors, to drift from your target mix as markets shift. Without rebalancing, a hot-performing asset can overweight your portfolio, increasing risk. A 2021 Journal of Financial Planning study found that unrebalanced portfolios can become 20% more volatile over 2 years, as skewed allocations amplify exposure to overperforming assets. In the Little Book of Common Sense Investing, John C. Bogle emphasizes that rebalancing maintains your intended risk level, preserving diversification. Picture 2 investors, Ava and Liam, both 40 years old with 60/40 stock/bond portfolios. Ava rebalances annually, selling stocks after a market rally to restore her 60/40 mix, keeping risk steady. Liam hasn't rebalanced in 3 years. His portfolio is now 80/20ths due to stock gains, and a market dip cuts his value by 15%. Ava's rebalancing limits her losses, while Liam's drift heightens his risk. Your lack of rebalancing signals a need to diversify. Not rebalancing doesn't just skew risk, it misaligns your portfolio with your goals, like retirement or wealth preservation. Regular rebalancing, annually or when allocations shift 5%, restores balance. The good news is that you can rebalance now. Review your target allocation, e.g., 70/30th stocks/bonds, and adjust by selling overweights and buying underweights. Try this. Check your current portfolio allocation. If it's off by 5% or more, rebalance by reallocating 10% this month. Reflect on your habits. Have you rebalanced recently, or let allocations drift? No rebalancing is a strong sign you should diversify, but you can realign your portfolio. Sign 4. You're not invested in international markets. The fourth sign that you should diversify your investment portfolio is not being invested in international markets, limiting your holdings to domestic stocks and missing growth opportunities in global economies, like Europe or emerging markets. International diversification reduces risk tied to your home country's economy. A 2020 Journal of International Money and Finance study found that portfolios with 20 to 30% international stocks reduce volatility by 15%, as global markets move independently. In The Intelligent Investor, Benjamin Graham advocates for global exposure to capture diverse growth and hedge local risks. Consider 2 professionals, Chloe and Max, both 33 years old with $200,000 portfolios. Chloe invests entirely in U.S. stocks. When a U.S. recession hits, her portfolio drops 20%, or $40,000. Max allocates 25% to international ETFs, and his portfolio falls only 12%, or $24,000, as global markets hold steady. Chloe's domestic focus amplifies her losses, while Max's global exposure mitigates them. Your lack of international investment signals a need to diversify. No international exposure doesn't just increase risk, it misses growth in fast-growing regions, like Asia or Latin America. Allocating 20 to 30% to international funds broadens your portfolio's resilience. The good news is that you can go global. Invest in a low-cost international ETF, like Vanguard's VXUS, to gain exposure to thousands of global companies. Try this. Check if your portfolio has international stocks. If none, allocate 5% to an international ETF this week. Reflect on your holdings. Are you globally invested or domestic only? No international markets is a key indicator you should diversify, but you can tap global growth. If you're still with us and finding this insightful, please comment number 4 below to let me know you're here. Your support inspires more content to boost your financial success. Let's move on. Sign 5. Your portfolio lacks bonds or fixed income assets. The fifth sign that you should diversify your investment portfolio is a lack of bonds or fixed income assets, relying almost entirely on stocks without the stabilizing effect of bonds, which offer steady returns and lower volatility. Bonds balance equity risk, especially during market downturns. A 2019 Journal of Portfolio Management study found that portfolios with 20 to 40% bonds reduce volatility by 25% compared to stock-only portfolios, as bonds often rise when stocks fall. In a random walk down Wall Street, Burton G. Malkiel stresses that bonds provide shock absorbers for portfolio stability. Imagine two retirees, Sophie and Ethan, both 60 years old with $300,000 portfolios. Sophie's portfolio is 100% stocks. A market crash cuts her value by 30%, or $90,000. Ethan's 60-40 stock/bond mix loses only 15%, or $45,000, as bonds hold firm. Sophie's stock-heavy portfolio heightens her losses, while Ethan's bonds cushion the blow. Your lack of fixed income assets signals a need to diversify. No, bonds don't just increase volatility, they expose you to larger losses, threatening financial security, especially near retirement. Adding bonds, tailored to your age, e.g., 30% for a 50-year-old, stabilizes returns. The good news is that you can add fixed income. Invest in a bond ETF, like BND, for diversified, low-cost exposure to government and corporate bonds. Try this. Check your portfolio's bond allocation. If under 10%, allocate 5% to a bond ETF this month. Reflect on your assets. Do you hold bonds, or only stocks? No fixed income assets is a clear sign you should diversify, but you can add stability. Sign 6. You're uncomfortable with market volatility. The sixth and final sign that you should diversify your investment portfolio is feeling uncomfortable with market volatility, experiencing stress or sleepless nights when stocks dip, indicating your portfolio's risk level exceeds your tolerance. A poorly diversified portfolio often amplifies volatility, triggering emotional reactions. A 2020 Journal of Behavioral Finance study found that undiversified portfolios increase investor stress by 30% during downturns, as concentrated holdings swing wildly. In Your Money in Your Brain, Jason Zweig explains that diversification aligns your portfolio with your risk tolerance, reducing anxiety. Picture two investors, Olivia and Ben, both 45 years old with $250,000 portfolios. Olivia's stock-heavy, undiversified portfolio drops 25% in a correction, causing her panic and prompting a rash sale. Ben's diversified mix of stocks, bonds, and international assets falls 10%, and he stays calm, holding steady. Olivia's discomfort reflects poor diversification, while Ben's balanced portfolio eases stress. Your unease with volatility signals a need to diversify. High volatility discomfort doesn't just cause stress, it leads to poor decisions, like selling low, locking in losses. Diversifying to match your risk tolerance, conservative, moderate, or aggressive, restores peace of mind. The good news is that you can adjust. Take a risk tolerance quiz, available on sites like Vanguard, and realign your portfolio with more bonds or diversified funds if needed. Try this. Assess your comfort with a 20% portfolio drop. If it feels unbearable, shift 10% to bonds or a balanced fund this month. Reflect on your emotions. Are you comfortable with market swings, or anxious? Volatility discomfort is the ultimate sign you should diversify, but you can find calm. Final thoughts. Now that you've explored these 6 signs, take a moment to reflect on your investment portfolio. Are you overly reliant on one stock or sector, neglecting international markets or bonds, or rattled by volatility, or are you building a diversified, resilient strategy? The good news is that an undiversified portfolio can be balanced, and every step you take, whether it's adding a bond ETF or rebalancing, is proof you're forging a path to financial security. These signs, single stock dominance, sector reliance, no rebalancing, no international exposure, no bonds, and volatility discomfort, highlight where your portfolio is vulnerable, but they also guide you to strength. Don't let concentration risk derail your financial dreams. Your wealth-building journey starts now. Pick one sign, like investing in an international ETF or rebalancing your allocations, and commit to it this month. Read books like The Intelligent Investor or A Random Walk Down Wall Street for deeper strategies, and consult a financial advisor for tailored guidance. A diversified portfolio can weather storms, capture global growth, and secure your future. Take action today, And let these signs lead you to a future where your investments thrive, your risks are managed, and your wealth grows unstoppable. If you're finding this inspiring, please comment number 21 below to let me know you're here.